Good day. My name is Omri Thomas. I'm the manager of the Net Group Investments Opportunity Fund. Thanks for joining us today. What I'd like to discuss today is just the outlook for the rest of the year. And as you've seen, the theme still remains the year of normalization. What do we mean by that? Well, we've seen a massive surprise in inflation globally, and that's resulted in an unprecedented response, a coordinated, synchronized response from global central banks increasing interest rates. So just to look at inflation, we can see that more recently it has started coming down, except for the UK, which remains stubbornly high. But even after reducing, still very high compared to historical levels. On the back of that, we have seen global bond yields increasing. Japan's been flatlining for more than 2 decades. Even they are slightly increasing their rates, but global policy rates now at more normalized levels. And this has resulted in an asset class that was basically uninvestable, really becoming investable. There are investment opportunities in global bond yields. You don't have to go out that far to get decent yields on developed market cash at the moment. Just looking at the valuations, this is the US earnings yield minus US inflation. So over time, you would want to earn a real return. So you want your earnings yield to be higher than your inflation. And historically, when this has dipped to zero, and you can see in the early 70s with the oil shock, 80s, the double-dip recession, and again now, it's actually turned negative. It's improved, but it's still negative. You can also see sort of around the dot-com boom in 2000, also touching negative. And this was historically not great for markets. We saw severe sell-off in markets. Market valuations are still relatively high given the tighter financial conditions, and on the back of that, we are a bit more cautious about the outlooks for markets. So just looking at South African interest rates, as you can see, the market is pricing in further rate hikes, probably another percent of interest rate increases, and for it basically to almost stabilize at that level. So further pressure on consumers, compounded by the immense amount of load shedding that we're also seeing. Looking at the SA bonds versus US bonds, as global interest rates have increased, we have seen that real difference narrowing. And as I said, global bonds now starting to become an investable asset class, but there is still a very nice real pickup that one can get being in SA bonds, both on a relative basis and on an absolute basis, just looking at where our inflation is running at. So SA bonds still a very attractive asset class for us. Looking at the fund performance over the last 3 months and year, we're still very pleased with the performance over the last year, substantially outperforming all the other balanced categories as well as the market. More recently, one would see that we are lagging a bit, and that is because we are quite cautiously positioned at this point in time. We think you're not getting paid enough for all the risk that you have to assume by having high exposure to risk assets, and you are getting paid for sitting on the sidelines and waiting for better opportunities to emerge. So looking at where the performance has come from over the last year, as one would have expected, the dollar or hard currency, the biggest contributor, as the rand weakened. Naspers, interestingly, when we did this a quarter ago, it was one of the major detractors. But from a year ago, Naspers has actually recovered significantly on the back of a very strong performance of Tencent and also renewed interest in Chinese tech shares. And also, as you know, that they've been buying back their own shares. British American Tobacco, long-term favorite. Over the last year, it's aided performance. More recently, it's been under pressure, and I'll maybe touch on that a bit later again. Thungela, also a small position within the fund over the last year, average weight of 1.3%, but almost contributed 1% to performance. We think there's more to come. They've got a strong balance sheet, decent results, and further strong dividends expected from them. And then Hello Group, the China reopening trade, we think will further benefit Hello Group. So we've retained our position in them. On the negative side, Sasol, it's one that I feel I'm always on the wrong side of. I apologize for that. It's Sasol impacted by lower oil price. We do think that as China reopens, we'll see demand recovery for oil, which should benefit Sasol. MTN, under pressure after they failed Telkom bid, as well as the Ghanaian tax, and load shedding really impacted the cell phone companies as their diesel costs explode, and they're under pressure to maintain stability of the network. Arabex looking very cheap as an infrastructure play, and under pressure as capital is just not being spent on infrastructure. We do think it's still a very a good long-term play if you want exposure to infrastructure. Then our structured notes had some accumulated gains, and we gave back some of that in the last quarter or in the last year. But the capital protection is in place, and it's close to current levels. So we're actually excited about our basket of structured notes and the potential return we can get from it. And then transaction capital, after this, reporting quite disappointing results with the write-down of the taxi business under severe pressure. We do think the market could have maybe overreacted on the news, and we've maintained our position. In fact, at the lower levels, we've actually increased our position in transaction capital, although it's quite a small position within the fund. Just the outlook for the rest of the year. It looks like the high global inflation is rolling over, but central banks are maintaining their tight stance, and we think rates will stay higher for longer, but the outlook's been tempered. So the market is starting to discount that in future we'll see interest rate cuts again. We think we worried about a global recession. It does seem like the market is pricing in sort of a soft landing, but I think there is a risk that a recession comes through. China reopening, we do think that it will be very positive for Chinese exposed shares, and there was a significant sell-off. So despite the recovery we've seen there, we think there could be more legs to that recovery. On the back of cost pressures, especially in South Africa, inflation, we do expect further earnings downgrades, which makes it difficult for companies to really grow with that cost pressure. So the SA economy, as I said, under severe pressure because of the perennial load shedding, up to stage 8 now, and I think it is a real crisis that needs to be dealt with. But as South Africans, normally these crises lead to eventual solutions. So it's going to be a tough winter, but hopefully we are at the turning point of how bad it can get. Further rate hikes expected locally, as I said. We think select SA equities offer value. We've seen some sell-off in, especially some of the banking shares got hit on the back of the concerns on US and global banks. We use that opportunity to tactically increase our position there, and we do think SA bonds continue to offer attractive real returns. So just the asset class outlook, as I said, SA bonds, emerging market equities, SA cash, looking attractive. The fair bucket, SA equities, but there's quite a range there. We think the rand is fair at this moment. Developed market equities, ex-US, fair, and then US bonds also in the fair bucket, with developed market bonds outside the US, developed market cash outside the US equities, and SA property we think still looks expensive. So just the fund positioning, as you can see, we've substantially reduced our equities from December 2021, so more defensive positioning. We've got a high weighting to bonds. We've got cash on the sideline to utilize if there any opportunities appear. And our offshore equities have gone up from 5% to 15% of the fund. just the top 10 equities for your interest. You'll see Naspers and British American Tobacco not in the top 10 anymore, but FirstRand as a bank and some of the tech shares that got sold down within the top 10. Thanks very much. I'll open it up for questions. Yeah, that's a very good question. We've had years of excesses and very low and accommodating monetary policy. And on the back of these increases, we've seen long duration assets with high debt really being under pressure. And I mean, Silicon Valley Bank and Credit Suisse, two of the casualties so far. We don't think that's the end of it. We think there's been a lot of leverage introduced, a lot of easy money that sloshed around in the economy. And the area that we're really worried about is global property. Property operating with high leverage, typically your global investment, your global property companies have got loan to values of 30, 40% plus, sorry. And we don't think they've completely repriced what's happened to both the cost on their debt, but also the cap rates on their assets. And if you do an adjustment, your marginal property companies could be under severe pressure. So that's the next area that we're really worried about. So we would expect to see further fallouts as we continue. Yeah, so that's a good question. As I said, it's not in the top 10 anymore. So on British American Tobacco, we reduced our position at fairly attractive levels. It got to over 700 Rand a share, and it was as high as it was over 5% of the fund at a stage. So our view was that as interest rates increased, the attractiveness from a yield alternative became less compelling. And you did see investors rotating back or rotating out of British American Tobacco after that increase. We think at current levels, it's actually very attractive. And in the more recent past, in the last week or two, I have actually started purchasing some British American Tobacco shares again. So just to put it into context, British American Tobacco has got a market cap of around about $60 billion. And they've got an investment in India Tobacco Company. They own 30% of the company. That's also got a market cap of about 60 billion. So just their stake in ITC is worth $18 billion per BAT share. So if you strip that out, you're paying under 45 billion for BAT, and they earn about 9.5 billion on that portion. So you effectively getting British American Tobacco at below a 5 PE, very cash generative, reasonably strong balance sheet. They're paying down their debt. Last year they bought back quite a lot of shares. They've paused it, but we think they'll start resuming it again next year. So again, I think it is a share that one can buy and put in the bottom drawer. On Naspers, as you know, we've had protection on our Naspers position. So into that big fall, we didn't incur all the pain, but into this massive run-up, we took some profits, and we also switched out of Naspers into some other more attractive Chinese tech shares. So examples would be Momo, Hello Group, Autohome. So these are companies that have got cash on their balance sheet that have, from a enterprise value basis, fallen as much as 90%. So we bought at pretty good levels. Quite a few of them have doubled from there, but we still think there could be some upside from those positions. So we've retained. In fact, it's crept up that in our top 10 there are now 2 or 3 Chinese tech shares. So we didn't want to further double up by having too high an exposure to Naspers, and that's why we've reduced that position. Yeah, as I said, we are worried about equity markets in general. We are worried about the SA outlook, economic growth outlook, and also the outlook for equity markets. So we are more cautious in the shares that we select. So we are more tactical in our positioning. So I think over time, what you'll see, we will reduce that further in favor of offshore companies where you've got a much wider universe and don't experience the same pressures that we are experiencing in the local economy.